It's a pleasure to be here. I recognize some faces in the crowd. That bio is a little old. I think I spoke with you guys back in 2019. We were at the Wind Creek Casino in Atmore. Auburn had just made a run to the Final Four in Bruce Pearl's 5th year. Did not make it to the championship game because of a double dribble that did not get called. 5 years later, here today, University of Alabama has made a run to the Final Four in Nate Oates' 5th year. I say all that to say this: assuming they invite me back to speak next year, if we have any UAB alumnus in the crowd, next year will be Andy Kennedy's 5th year at UAB, so you might can purchase tickets to the Final Four. But with that being said, glad to be here. My name is Keith McKinley. I'm the Chief Relationship Officer at Alabama Ag Credit. I have been there for 7 years. You saw a little bit about what we do, the relationship aspect of it. Some of you guys may relate to this as being a Chief Lending Officer. From our perspective, the way we look at that is we don't look at it from a financial institution as being a transaction-based organization. We're more relationship-based. And so Chief Relationship Officer is my title. Don't ask me. I've been married for 18 years, but I don't give marital advice or anything like that. So overview of Farm Credit. What we do, Alabama Ag Credit is part of the Farm Credit System. Created in 1916, we are a government-sponsored enterprise. We are a network of cooperatives. You can read all of that up there. We do finance approximately 46% of the farm debt across the United States. The portfolio is diversified. From your perspective, you're really interested in Timberland, and we'll get to that here in just a second. Regulated by the Farm Credit Administration, and the jurisdiction obviously was in the House and Senate Agricultural Committee. Advantage of the cooperative system, whether we're Alabama Ag Credit or any of our colleagues, I've seen some of our colleagues from First South in here. They're part of the Farm Credit System as well. Our sister company is Alabama Farm Credit in North Alabama. We serve the lower 40 counties of Alabama. Cooperative ownership, we're owned by our stockholders, so when you borrow money from us, you become a stockholder. Okay, so that is different. It is a financial cooperative. Shared earnings. I think last year we made just slightly over $20 million in income. We gave back $12.1 million to our stockholders. That's because of the financial cooperative nature of that. So we are required to keep some for capital reserves, but we do give that back in the form of a patronage dividend. Transparent governance, stockholders are served on our board of directors. So we have everybody who is on our board, elected to our board, is also a borrower of Alabama Ag Credit or the Farm Credit System that you're affiliated with. Here's a territory. You can see Alabama there. We are what they call overchartered. We have Ag First and Farm Credit, the Farm Credit Bank of Texas, both serve the state of Alabama there. The 4 funding banks, Farm Credit Bank of Texas, Ag First, AgriBank, and CoBank, and you can kind of see how they fit with the parameters of the United States. Gross loans, you'll see here. Most important thing that's most updated is second quarter 2023 for you guys in this room. More than likely, it's going to be that general ag and the blue up there. You can see that's primarily what we do. That's a lot of Timberland. It's other things as well, but we do, and I will get to this in a second as well, but we do a lot of other things. But for you guys in this room, Timberland seems to be the topic of this conference, so we'll stick to that. But majority, what I want this slide to demonstrate to you is the majority of what we do is land, real estate, timberland. Do serve all 50 states and the Commonwealth of Puerto Rico. Very diversified. Highest concentrations, in, surprise, in California, 11.9%. Ag diversification. For you guys, you'll see bottom left there, forestry comprises about 6% of what we do, or what the Farm Credit System does. But I will tell you this, from our perspective in the state of Alabama, timber is the second largest commodity behind poultry. And within our portfolio that we have, it is the #1 commodity that we do at Alabama Ag Credit. So the majority of what we do is timberland and real estate loans. You see this by dollar size. Obviously, there's some some very large numbers up there. But on the right-hand side, what I want you to see is we don't discriminate. We do everything from small loans to larger loans. You see the majority of the percentage of borrowers are in that $250,000 or less bucket, but we can do anything up to any amount. There is no max for us in what we can and can't do. There's no minimum either. As long as it fits in the parameters of what Farm Credit allows and the regulation, we can certainly do that. This is our territory. Alabama Ag Credit's territory is 4 regions, 9 branch locations, 93 employees. We're about $1.3 billion in assets. So not small, not huge, but we feel like, it's kind of happy medium. We're trying to grow all the time, don't get me wrong, but $1.3 billion is not, your Chase banks and your Wells Fargo's, but it's not your, slightly bigger than some of your community banks as well. Well, Alabama Ag Credit, mission-driven, we're cooperative, service and ag knowledge, rates, that's the topic these days. I'm sure I'll get that here in a little bit when I open it up for Q&A is where rates are. I don't know if you guys have been following the 10-year Treasury, but it's on a ski slope the wrong direction based on information that's come out the last few days. Consumer price, CPI, PPI, housing starts are down. It's a lot of different things, but the thought process was that the Fed would probably start late second quarter and reducing rates. It's looking more toward third quarter, fourth quarter, but your guess is as good as mine. I saw yesterday that the Federal Reserve Bank of Atlanta's first quarter estimated GDP is 2.9%. So we'll see. Job numbers, there's still plenty of activity out there in the economy. So, the Fed's 2% mandate or trying to get to that 2%, it's kind of, they're just taking a wait and see approach, waiting on data to keep coming in, figure out, when's the right time to reduce rates. I can tell you from our standpoint, the sooner the better. I'm sure from your standpoint as well. So this is what we do. I'll leave this up here. Kind of gets into the topic I was asked to speak about, which is timber financing successes. And it's kind of a broad topic because, again, we're in the relationship business, so everything that we do, every loan that we book, we consider that a success for us. Mainly because it is a transaction, but it's also a relationship. And I've been truthful and transparent when I tell you we take that very seriously. We know there's a lot of competition in the market. You can go anywhere you want to or go online and get any rate, quotes, anytime you want. And we know that. So from our perspective, we are constantly trying to sell ourselves, sell our products, understanding that we're going to be there in the good and the bad. We don't run from it. A lot of financial institutions will get into the market for a certain period of time. Times get bad, they'll exit. We'll pick up that. Nothing wrong with that. There's nothing wrong with that strategy at all. The way the Foreign Credit Administration has it for us, we have a sandbox we have to stay in. We don't get to run and go do other things. We're specific to ag. We're chartered and charged to serve rural America. So that's what we'll do, and that's in good times and bad. So timberland owners in here, success stories, everyone's a success story, but let me just give you a few things, out of the box things that we do from time to time as it relates to timberland. For those of you who are going to look at buying new timberland, right now, especially in this market, cash is king. Nobody wants to turn loose of cash just because nobody knows what the economy is going to do. We fully recognize that on our side. The Farm Credit Administration on long-term financing requires that we have at least a 15% equity infusion, meaning a 15% down payment. In your situation, if you didn't want to take cash out of your pocket to put 15% down, we could take other real estate in lieu of cash. Assuming you're okay with us mortgaging that real estate, if you want to hold on to that cash, we could do that. For instance, had a guy looking to buy 80 acres, had 40 acres free and clear. Actually, it was 40 acres we already had mortgaged, had a good bit of equity in that. He already had the property mortgaged with us anyway. So we just took a mortgage on the 80, took a second mortgage behind ourselves on the 40, and the guy kept the cash in his pocket. With the idea being that if things turn around and the economy gets better, he could take some of that cash that he has that's earning pretty good dividend in the bank right now and pay us down and pay that mortgage off. So your money is sitting in an investment account, earning good money right now. Rates are high, but so are dividend rates. They're high as well. But you could use other collateral, keep making money on your money, and then if the economy ever turned, you could take that money and pay us off if you wanted to. Just a way for you to keep cash in your pocket. One of the other things I've seen talked about, or the first speaker this morning was talking about, just the general improvements to the property, RLOCs, so revolving lines of credit. You have things you want to do to your property. It may be something as simple as, prepping, planning, burning, fencing, putting roads in, culverts in. We can take a mortgage on your piece of property and give you a line of credit that you do those things. So good thing about that is you only pay interest on what you draw. So if you take out a line of credit and you never draw off of it, you don't pay any interest on it. You take, you get a line of credit, you take a draw off of it, to plan or whatever that is. You may be planning and be cutting at the same time. You may be, or vice versa. You may have one stand that get ready to cut and you know what's coming, but you got another stand you just cut and you need to be planning or you need to be prepping for that. Then you have a line of credit that will allow you to draw off to do those things, keep cash in your pocket. Then when you go cut that stand, turn around and pay it off. So it just gives you flexibility. It also gives you flexibility. We have a lot of people who do this. They'll take a piece of property, have a line of credit on it, because right now, as you know, if you've looked in the real estate market, nothing stays on the market very long at all, if it even gets to the market. A lot of what's being bought right now is pocket listings. So it's being bought. The ability for you to be able to mobilize quickly and jump on that piece of property without having to go through title work and appraisal and all that stuff is important. So a lot of people, I say a lot, some have opted to put up collateral for future real estate purchases. So what that enables them to do is basically, hey, they got a line of credit sitting over there for whatever amount it is. They want to go buy that 80 or 100 or 200. They're competing with another potential buyer. They know that if the quicker they can close and less contingencies they have in their sales contract, the more likely they are to win the deal. That line of credit allows them to mobilize really, really quickly and get cash really, really quickly. And assuming you're okay with that piece of property, you could close as soon as the next day if you wanted to. I wouldn't advise that. I'd make sure you get a title commitment and things like that, and make sure you understand that the person you're buying it from can legally convey the property to you. But if you knew that, you could technically call us and go, hey, I need whatever amount to fund a purchase, and we could wire that to you that same day or have it to you the next morning. So it gives you that flexibility. So you have using real estate in lieu of cash for purchases. You have the line of credit aspect of it. One other thing that we do that people are more and more taking advantage of is timber advances. And so the way this works is kind of tedious, but we do it, and we do it quite often. Say that the one example I always use is you're buying a piece of property that needs to be thinned. You know it needs to be thinned. And you go out there and do your analysis, and you understand, hey, it's whatever dollar amount that is, 15% of whatever it's going to cost for your down payment. You understand that, hey, I can probably get that just by thinning that property. Okay, you can get that 15% down. We will actually allow you to do a timber advance for that. So you would not have to come out of pocket the 15%. You could actually sign a contract with whoever you want to. We get a copy of that contract. We know exactly what they're going to pay you, or approximately what they're going to pay you to thin that tract. We would verify that amount is enough to cover your down payment, and then we move on down the road. So we'd have a pre-closing appraisal and post-closing appraisal. The thing about thinning tracts is the property typically doesn't appreciate when you do it. Actually, it appreciates when you do that. And so from our perspective, we look at it and go, hey, it's an appreciating asset anyway. You're thinning a tract. It's not going to hurt the value of the tract. And in the meantime, it helps you stay liquid as well in terms of, hey, again, you don't have to come out of pocket for that. It's a timber advance. We do it routinely. There is one-off situations where you'll find a piece of property, used to, not anymore. You might find a piece of property that somebody's trying to unload because they need money or whatever it may be, and you can buy that property for basically dirt value, not even any timber. Assuming that those are very one-offs, by the way, but we have had that happen. You could do the same type concept. you could get a timber cutting contract and use the proceeds for your down payment. So those three options right there in terms of real estate in lieu of cash, keeps cash, timber line of credit, a timber RLOC or timber revolving line of credit, and basically essentially allows you to keep cash in your pocket, which in this economy right now is what everybody's looking to do, is keep cash in their pocket. Some other things have been pretty prevalent in the last 12 to 18 months. Conservation easements. We've seen a lot of those come across, especially on hardwoods. Not so much on pine plantation, but hardwoods. We've seen those. We have no problem subordinating our mortgage to a conservation easement, assuming we understand the baseline report and what's being done there. So a lot of lenders will take an exception to that. They will not want to subordinate that lien. We have no problem doing that, assuming we understand what the end goal is. So we got to have a copy of the easement, the baseline documentation report, and then you guys can, or some folks are taking advantage of the tax credits you get for a conservation easement. So success stories, all of them are success stories. Those are just 2 or 3 tools that we can do. When I ask folks, what are some things that you would like to talk about or like to hear, a lot of them was about cash. How is it that I can get in a piece of property, or how is it that I can improve my property without coming out of pocket cash, because I'm just not sure what this economy is going to do? Well, those are just 2 or 3 ways that we can help you do that. With that, and in the spirit of the election year, I will yield back my time. Unless you have questions that you'd like to, I'd be more than glad to answer any questions you may have, whether now or during the break. Thank you. Yeah, absolutely.